Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Tuesday, 22nd July. Coming up on the show, the S&P 500 and Nasdaq hit record highs again. Can anything derail them? And earnings season continues. We'll have the latest from the likes of Coca-Cola, GM and RTX. And we'll also have the latest from the world of crypto. So grab your coffee and let's own the morning. Well, let's kick off with the things you need to know before the opening bell rings by taking a quick look at where US stock futures stand. Now, it looked like a bit of a sea of red to start with for the Dow Jones and perhaps not surprisingly for both the S&P 500 and Nasdaq. And that's because both of those notched record high closes on Monday. What's behind this? Well, they were lifted by Google parent Alphabet and other mega caps ahead of several key earnings reports this week. More on that in a moment. But also it seems that investors are betting that potential trade deals will be able to offset any economic damage from Washington's global tariff plans. So far, the S&P 500 is up over 7% this year alone, and actually over the last 3 months, it's up around 19%. Analysts on average expect S&P 500 companies to report a 6.7% increase in earnings for the second quarter, with big tech leading the way. And that brings us on to the next thing you need to know before the opening bell rings. The first of the Magnificent Seven are on deck this week. Tesla and Alphabet report tomorrow. And then next Thursday, it'll be the turn of Amazon. We'll have more on Tesla later in the show. But Alphabet shares on Monday were up 2.8% and look set to open higher this morning too. Now, last quarter, Alphabet significantly surpassed Wall Street expectations, highlighting momentum across its search, cloud and AI businesses. Analysts expect that these parts of the business will likely show similar success this quarter. Now, it's clear that market sentiment will be driven by what we hear from the Mag 7. Almost a third of the S&P 500 is made up of them. Now, in recent times, the markets have often punished Mag 7 stocks for earnings results that have been good, but not great. And in fact, analysts at Bank of America are predicting the Mag 7 will only keep its earnings growth edge over the rest of the S&P 500 for another 18 months. Now, the final thing you need to know before the opening bell rings takes us to the world of crypto. The Genius Act was only signed on Friday, but plenty of moves are happening. We found out that Trump Media and Technology Group has invested $2 billion in Bitcoin. Its share price jumped over 3% yesterday and are set to open higher once that bell rings, up about 1.6% there. Now, the positive market reaction to the news reflects investor confidence in the company's strategic direction and the potential for Bitcoin to drive future growth. The surge in Bitcoin prices, which has reached $120,000 not so long ago, now trading above $118,000, underscores the potential for the whole of the cryptocurrency market. And a report this morning in the Financial Times has said that JP Morgan is actually looking at expanding into crypto-backed lending. Now, on Monday, shares of crypto-linked companies jumped and other cryptocurrencies also had a good day, with one in particular hitting an all-time high. Our very own Inez Ferre discussed the latest moves with Julie Hyman.
Ether, the second largest cryptocurrency by market cap after Bitcoin, recently hit its highest level since January. It's up 60% over the past month. Joining me now with a closer look at what's driving this momentum is our senior markets reporter, Inez Ferre. So what's going on there?
So, Julie, there's a lot of enthusiasm around Ethereum right now. And this is not just because Ether is going to be going up in price, but because companies have this bullishness about the entire infrastructure, the network, so to speak, as the financial services industry converges with the crypto world. So what do I mean by that is that what analysts are telling me is, look, you are now have the ability to tokenize real world assets. And that can be anything. That can be gold, that can be currencies, as we've seen also with stablecoin, for example. It can be art, it can be real estate. And those tokens can be stored and moved on the Ethereum blockchain. So the reason why we've seen such a surge in Ethereum recently, really over the last month, we've seen it up more than 60%, is because of this bullishness around the architecture, the infrastructure, the financial layer, so to speak, or the financial network infrastructure around all of the innovation that's happening in the digital space and when it comes to financial services. So many stable coins run on Ethereum, and we saw a huge surge after the Genius Act was passed. And you also have companies like the miner, for example, BitMine, which went public on June 5th, on the same day that Circle went public as well. And they have now acquired more than $500 million of Ethereum. So that's a pure play on Ethereum. Now, this does not replace this Bitcoin strategy. And you have companies like Strategy, for example, Michael Saylor's Strategy, and he has said he does not plan to buy Ether. His bet is on Bitcoin. Bitcoin is the one that he sees as the commodity, as valuable. But as far as other companies are concerned, they're very much betting on this infrastructure, the network behind this convergence of the financial services and the crypto world.
Okay, let's have a look at what's moving the markets today. Well, we have earnings out before the bell. Coca-Cola, General Motors and RTX. First up, Coca-Cola. Revenue for the second quarter coming in at around $12.55 billion, which is more or less what was expected. Adjusted earnings per share coming in at 87 cents versus 83 cents that was expected. Expectations were high. Last year's sales jumped 15% in the same period. Going into the report, analysts expected steady growth, especially overseas, despite the effects of inflation, global economic uncertainty and slow consumer spending in some areas. President Trump recently announced that Coca-Cola has agreed to switch to cane sugar from high fructose corn syrup in its signature drink. Now, Coca-Cola has confirmed this switch, and its shares are trading higher in the pre-market. Okay, next up, we look to General Motors. Revenue for the second quarter coming in at $47.12 billion versus $46.25 billion expected. Adjusted earnings per share coming in at $2.53 versus $2.33 expected. General Motors highlighting the hit to its quarterly profit from President Trump's tariffs. The company previously said it expects $4 to $5 billion in tariff impact this year, a third of which it plans to offset through cost cutting. Now, finally, we go to RTX. It's also got results out, reporting second quarter revenue of $21.58 billion versus $20.6 billion expected, and adjusted earnings per share of $1.56 versus $1.45 expected. Those shares are down in pre-market. Now, the defense and aerospace giant providing details about how tariffs may impact future profits. Investors are also watching out for updates around the company's role in the US defense initiative. The proposed Golden Dome missile shield, which aims to block hypersonic missiles and nuclear weapons, among other things. The project got over $24 billion in the One Big Beautiful Bill signed by President Trump earlier this month. Okay, well, it's time now for a quick break. When we come back, we'll have a deep dive into commodities. Stay tuned. Well, welcome back to Market Sunrise. We're going to jump in with our colleague Jared Blickery, who goes into detail on the commodities supercycle.
Stocks are sitting at record highs, metals are on a tear, and Uncle Sam running $2 trillion deficits. And add to that the potential for more Fed rate cuts, something might need to give. In this episode of Stocks in Translation, we're going to break down the fragile relationships that have been sending stocks and metal commodities higher. And to help decipher all these market riddles, let us now turn to the macro insights of Alfonso Picatiello. He is the founder of the Macro Compass. Now, we can simplify the levers in the economy and identify which ones are fixed and which ones are variable. Critically, nothing is truly fixed, and there are multiple ways for the steam in the system to escape. So this table behind me breaks down some of the key drivers. Let's start with short-term yields at the top, which the Fed directly controls, by the way. Powell and Co., they have anchored them to about 4.25%, and investors are expecting 2 more rate cuts this year. A tight Fed is what markets want to avoid, so this lever is pretty much locked for the time being. Now, moving down the yield curve to longer-term yields, this is Treasury Secretary Scott Bessent's department, and he is talking buybacks on long-dated government debt, and that's to cap the 30-year yield near 5%. This is the critical level. If it holds, pressure flows elsewhere. Next up, the dollar has been trending down most of 2025 due to massive fiscal imbalances, but tariffs add a twist as they arguably support the dollar. And as the critical August 1st tariff deadline approaches, we want to keep an eye on reactions in the greenback, which is the dollar. Now, moving on to stocks finally, they love low rates and a weak buck, but we were just talking about that, by the way. If they hold, then equities could keep pushing higher, and guess what? Earnings matter too, but that story takes a little bit longer to play out. Finally, we have commodities at the bottom and precious metals. Much like stocks, they also tend to rally when rates are pinned and the dollar is weak. Palladium and platinum, they have been big release valves recently, but also gold and silver and copper, they've been flying high this year too. Now we have a chart. This goes back to 1965, and it's of the 20-year yield, showing long-term rates measured on the left axis, and then we have the 5-year rolling return of an index of metal commodities on the right axis. We want to study what happens when metals really go on a tear, and if we actually do have a few big cycles to look at. Now, at the left of the chart, the 20-year yield in white doesn't move that much until we hit the 1970s, when it moves up in 2 phases into the end of the decade. Commodities in green also sharply move higher in 2 phases, or spikes. That's classic inflation and capital flight, meaning no one wants to hold dollars. In the early 1980s, Paul Volcker at the Federal Reserve, he pushed those white yields to near 15%. Imagine those mortgage rates. That absolutely crushed the metals rally, and the green line plunged below zero. Now, things were quiet in commodities as yields trended down for 2 decades. That's in the middle of the chart here. And then in the early 2000s, yields would be capped at around 5 to 6%. Commodities in green would surge to 200% as a global savings glut found its release in all types of commodities, from metals to crude oil to even food inputs. Now, in more recent years, from 2013 to 2019, both of these lines were relatively quiet, and we didn't have those exploding pandemic debts just yet. But now, at the far right of the chart, we can see that green line for metals once again turning higher, and long-term yields are now reversing the 4-decade decline as Bessent & Co. at the Treasury try to keep them under 5% with exploding fiscal imbalances. So here's what you want to keep an eye on for the future. Number 1, watch that 30-year yield. If it breaks above 5%, it is a big warning that the bond vigilantes have taken control from the Fed and the Treasury. Next, watch out for a Fed pivot. The next move is expected to be a cut, but if CPI inflation runs hot, that might take the move off the table. Also, if Bessent is not able to cap the 30-year yield at 5%, the Fed could theoretically pull another Operation Twist, and I should stress that this is not being discussed right now. And as August 1st rolls closer, watch for surprises in tariffs, as well as how they shape the economic data in the months to come. And next, always watch the dollar. If it breaks lower, that adds fuel to the fire for both metals and stocks, but given the hugely bearish positioning and sentiment, it could also rip higher and force out the shorts. This would likely put a crimp in the stocks and metal rally. Now, finally, keep an eye on commodities momentum. If the 30-year yield blows through 5%, we could see some true froth in everything from gold to copper to food inputs like grains and livestock. Even crude oil could catch a bid. So the bottom line is, if the Fed and the Treasury can hold the line on rates across the curve, expect the dollar to drop and metal stocks to continue their run along with stocks. But if the cap breaks, the party could turn into a 1970s flashback full of inflation and volatility. This story is just getting started, so stay tuned. And tune in to Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Great analysis there from Jared as always. It's time now for another break, but stay tuned to Yahoo Finance for today's trending tickers. That's up next on Market Sunrise. Well, it's time now for today's trending tickers. AstraZeneca, Philip Morris and D.R. Horton. First up, AstraZeneca. Well, it plans to invest $50 billion by 2030 in the US, becoming the latest pharmaceutical giant to ramp up investment in the wake of President Trump's tariff threats to the industry. The investment includes building new drug factories and expanding research and development centres. The cornerstone of the investment is a multi-billion-dollar drug substance manufacturing centre focused on chronic diseases in Virginia. This is the company's largest single investment in a facility to date. The announcement follows similar moves by Eli Lilly, Johnson & Johnson and Novartis, among others. Now, President Trump has demanded more reshoring of domestic manufacturing and recently threatened tariffs within the industry of up to 200%. OK, next up, a couple of earnings movers, starting with Philip Morris. Now, reporting second quarter revenue of $10.14 billion versus $10.3 billion that was expected, so a miss there, and adjusted earnings per share of $1.91 versus $1.86 estimated. Shares in pre-market down there, now over 3% actually. Now, the company boosting its full-year adjusted EPS forecast, seeing $7.43 to $7.56. It previously saw $7.36 to $7.49. Now, in the third quarter, the company expects total product volume to grow about 1% for the year. Going into the report, analysts touted the company's growth of smoke-free products, including Zyn, a brand of tobacco-free nicotine. And finally, D.R. Horton is also out with mixed quarterly results, reporting third quarter revenue of $9.23 billion versus $8.76 billion estimated, and diluted earnings per share of $3.36 versus $2.90 estimated. The company narrowing its revenue forecast for the full year, seeing revenue of $33.7 billion to $34.2 billion versus a previously seen range of $33.3 billion to $34.8 billion. Outlook also sees roughly 85,000 homes closed in the year. The firm's executive chairman saying new home demand continues to be impacted by ongoing affordability constraints and cautious consumer sentiment. They expect sales incentives to remain elevated and increase further during the fourth quarter. Now, the majority of analysts have a hold rating on the stock. Now, another stock that we're watching closely is Tesla, with earnings out after the closing bell on Wednesday. William Blair's Jed Dorsheimer joined Yahoo Finance's market domination.
Quite frankly, I think if you're a trader and you're looking at the very near term, you could actually get, a little bit of upside here. But my job as a fundamental analyst to try and look at what's happening over the next 1 to 2 years or sometimes even longer. These are going to be challenges to the business until robotaxi or humanoid robots, until those business units become a larger, more material part of the of Tesla's P&L.
If we're aware of these challenges, though, Jed, Musk is aware of them. So what are the levers he's going to pull to navigate these dynamics?
I mean, I think you're seeing some of that in terms of change of personnel. And, I would suspect that, they're not going to allow the vehicles. So I think they're going to push really hard. And I think Elon's getting back into, the position he probably feels most comfortable in. He is a great operator and leader, and I think he's going to push hard now that his focus is squarely on Tesla.
So for our call of the day, we're going to take a closer look at an upcoming IPO. Design software maker Figma is aiming to raise as much as $1 billion in its IPO, which would value it at around $16.5 billion. Now, this will be a crucial test of market demand for tech startups. The San Francisco-based firm has a reputation of being a favorite of Silicon Valley venture capitalists and has been gearing up for a New York listing recently. This after the collapse of its proposed $20 billion merger with Adobe in 2023 over regulatory concerns. Now, Figma is looking to market almost 40 million shares at a range of between $25 to $28, according to regulatory filings that were placed on Monday. Now, the deal is expected to price at the end of the month. Figma's revenues over the first 3 months of 2025 was $228 million, with net income of $45 million. Now, Figma also announced 2 new additions to its board: Instagram co-founder Mike Krieger and Duolingo's co-founder Louis von Hahn. It also holds around $70 million in a Bitcoin ETF, and it plans to allocate more to it. And it also disclosed plans to use blockchain common stock in its filing. Interestingly, Figma will allow existing shareholders to sell shares, and Figma's founder and CEO Dylan Field has disclosed he plans to sell over 2 million shares. Well, despite this, he'll still hold 74% of the voting rights after the IPO. Now, Morgan Stanley, Goldman Sachs, Allen & Company and JP Morgan are acting as joint lead book runners for the proposed offering. It's certainly an IPO we'll be watching closely here on Yahoo Finance. Okay, now let's hear from KeyBank Capital analyst John Vinn to hear about the current state of the AI chip market. He was speaking to my colleague Josh Lipton on market domination.
I think the AI chip sector remains broadly very resilient. I think there's very strong, robust demand across the board. And then with the recent news that the U.S. administration now has lifted the AI chip ban on chips to China, companies like NVIDIA and AMD are once again going to be able to start shipping into the China market, which is obviously a very significant market for the AI sector.
And so, John, do I stick with NVIDIA and Broadcom here? Do they remain overweight? Do they remain buys? No AI CapEx peak in sight?
Yeah, I would say those are probably the 2 best positioned companies within the AI chip sector, right? NVIDIA, obviously, we think they have a significant commanding lead in the space. The shift to their Blackwell rack scale GB200 system is a game changer. It really places a lot of distance between them and the competition. And then Broadcom, we also think is really well positioned in the AI chip space. I think thematically, how we think about it is Broadcom is kind of the leader in the custom AI silicon space, right? Their largest customer, Google TPU, by far has one of the most successful custom AI chip solution in the sector. And then they're starting to ramp in the second half here, Meta with their MTIA AI chip, which also should be an incremental tailwind.
Okay, that's almost all we've got time for. Let's have a quick look at the markets before we go. We start with the US futures, and after yesterday's pretty impressive performance from the S&P 500 and the Nasdaq, all looking a bit more negative this morning, perhaps waiting to see what the tech earnings that we see tomorrow, especially with Tesla and Alphabet. If we go over to Europe, Asia markets now, and a bit of a mixed bag there. Actually, the Nikkei down. There's a bit of political uncertainty there, so keep an eye on that too. Anyway, let's have a quick look at Europe as well. All in the red there. Interestingly, the FTSE down there as well. Some pretty bad news on debt numbers earlier this morning. And that's it for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. Coming up next, join Julie Hyman on her show Morning Brief at 9 a.m. Eastern. I'm Ramzan Karmali. Go own the morning.